Have you ever logged into your banking app, stared at your balances, and thought, is my money actually in the right place? If you're keeping all your cash in just one account, or if you're transferring money back and forth without a real strategy, you are likely leaving free money on the table and setting yourself up for totally avoidable fees. We are tackling the absolute foundation of personal finance: the checking account versus the savings account. It sounds simple, right? But you'd be surprised how many people use these two accounts completely wrong. By the end of this video, you're going to understand exactly the hidden traps banks use to drain your money, why standard savings accounts are basically useless today, and, most importantly, how to build an automated system that uses both accounts to grow your wealth on autopilot. Grab a notebook and let's dive in. The checking account, Grand Central Station. Let's start with the checking account. I want you to think of your checking account like Grand Central Station. Money is constantly arriving, and money is constantly leaving. It's chaotic, it's fast-paced, and it's meant for short-term stays. A checking account is a deposit account designed specifically for your everyday, routine transactions. This is where your paycheck lands. It's where your rent or mortgage gets pulled from. It's what is linked to your debit card when you buy groceries or swipe for a coffee. Because it's designed for heavy traffic, you have almost unlimited access to your money. You can withdraw cash from an ATM, write physical checks, yes, people still use those, use a debit card, or send money instantly through apps like Zelle or Venmo. But here is the catch, and it's a big one. Because banks have to keep this money easily accessible to you at a moment's notice, they generally do not pay you for keeping your money there. The interest rate on a standard checking account is usually zero. Nothing. Nada. And worse, if you aren't careful, checking accounts can cost you money. Watch out for these three massive traps. Maintenance fees. Some big banks charge you $10 to $15 a month just for having the account open, unless you maintain a certain minimum balance or have direct deposit set up. Overdraft fees. If you spend more than what's in the account, the bank might cover it, but they'll smack you with a $35 fee for the privilege. Out-of-network ATM fees. Using another bank's ATM? That'll be $3 from them, and another $3 from your own bank. So, what's the golden rule for checking accounts? Only keep enough money in there to cover your monthly living expenses, plus a tiny buffer, say 10% to 20% extra, to avoid accidental overdrafts. Every single dollar above that is losing value to inflation because it's earning zero interest. Which brings us to the savings account, the vault. If your checking account is a busy train station, your savings account is a vault. It's quiet, it's secure, and money goes in there to stay for a while and grow. A savings account is a safe place to store your money for future goals, emergencies, and large purchases. Because the bank knows you aren't going to spend this money tomorrow, they use it to fund loans for other people. In exchange for letting them use your money, they pay you interest. Now, standard savings accounts from traditional brick-and-mortar banks are notorious for paying absolute pennies. We're talking about an annual percentage yield, or APY, of around 0.01%. At that rate, if you save $10,000, you'll earn a whopping $1 in interest over an entire year. This is why you must absolutely, positively look into high-yield savings accounts, or HYSAs. High-yield savings accounts are usually offered by online banks. Because they don't have to pay for physical branches or tellers, they pass those savings on to you. Instead of 0.01%, a good HYSA right now can pay anywhere from 4% to 5% APY. Let's look at the math. If you put that same $10,000 into a 4.5% high-yield savings account, you aren't making $1 a year. You are making $450 a year. For doing absolutely nothing. That is the power of putting your money in the right place. But savings accounts have restrictions. They are not built for everyday spending. Historically, the government enforced something called Regulation D, which limited you to only 6 withdrawals from a savings account per month. If you went over, you were hit with a fee. While the Federal Reserve technically paused Regulation D in 2020, many banks still enforce their own 6 withdrawal limits. Furthermore, savings accounts almost never come with debit cards or checkbooks. To spend the money, you usually have to transfer it back to your checking account first, which can take 1 to 3 business days if the accounts are at different banks. This friction is actually a good thing. It protects your savings from you. When it takes 3 days to access your cash, it prevents impulsive, late-night Amazon shopping sprees. The ultimate two-account strategy. So, how do we put this all together? The biggest mistake people make is choosing one over the other. The secret to managing your money like a pro is using a hybrid system. You need both, and you need them to talk to each other automatically. Here is a simple, foolproof strategy you can set up this week. Step 1. The funnel. Set up your direct deposit so your paycheck lands in your checking account. This is your home base. Step 2. Pay the bills. Leave exactly enough in the checking account to pay your credit card bills, rent, utilities, and groceries, plus a $200 buffer just in case. Step 3. Automate the savings. Now, calculate what's left over. Go into your bank app and set up an automatic recurring transfer. The day after you get paid, automatically move your savings portion directly into your high-yield savings account. Do not rely on willpower. If you leave the money in your checking account, just in case, you will spend it. By automating it, the money is out of sight and out of mind, quietly earning 4% or 5% in the background. But what exactly should be in that savings account? 3 main things. Your emergency fund, 3 to 6 months of basic living expenses in case you lose your job or your car breaks down. Sinking funds, money for known upcoming expenses, like a holiday vacation, property taxes, or car insurance. Short-term goals, saving for a wedding, a down payment on a house, or a new car within the next 3 to 5 years. Quick side note, if your goal is further out than 5 years, like retirement, that money shouldn't be in a savings account at all. It should be invested in the stock market. But we'll save that for another video. To sum it all up, use your checking account to pay your bills and live your life. Use your high-yield savings account to protect your future self and let your money multiply. Take 15 minutes this weekend to look at your accounts. If you have $10,000 sitting in a checking account doing nothing, open a high-yield savings account and move the excess. It is literally free money waiting for you to claim it. Now, it is time to destroy that like button. Make sure to subscribe and hit the bell icon so you don't miss our next video. Thanks for watching us.